And this time around the majority has got it right. Reserve Bank of India has kept key policy rates unchanged, which means no repo rate cut, no CRR cut. It's status quo. I guess Reserve Bank of India clearly has indicated that it's the January policy which is the bigger policy, which will be an important policy. Market reaction, expectations were low, so you may not see a sharp reaction on the downside. Where is the Nifty? 22 points down. It could recover. This just could be some kind of a panic unwinding. And George Cherian is ready. George, we read a lot, but nothing came out.
Right, Nikud. So it is, right, absolutely a non-event like we were saying. So we've been saying this since yesterday. No action on either the CRR or the repo rate. And the ET Now poll was also indicating exactly that. Now, what comes out as a positive really from this statement is the fact that the RBI has said that from here on, the focus is clearly going to be on growth going forward. They have said that they will stick to their guidance of a rate revision in the fourth quarter of the current financial year. So the assumption that the majority of the market is working with, that you will see the first rate cut come through possibly on the 29th of January, remains. The RBI has reiterated that. And the policy stance really of the Reserve Bank of India going forward is hugely dovish. They've said that the focus now will move away from inflation management and focus on supporting growth. So that's a big positive really. And while the governor may have disappointed by not acting on the rates front, the commentary in his statement is hugely supportive of growth going forward. They have talked about, of course, risks emanating to emerging and developing economies from the global situation, but they have also said that things have begun improving over there, and that it is today largely only political risk that can actually derail things for emerging markets. So whether it be issues over the fiscal cliff where politicians in the US are still at loggerheads in terms of coming to some sort of a settlement to avert the cliff within the next 14 to 15 days, or be it issues in the Eurozone that need to be resolved through political will. These, in the RBI's view, are the real risks that sort of stand in the way of a full-fledged recovery even in the emerging market. So otherwise, they've talked about a number of economic fundamentals in the OECD region actually beginning to look up despite the numerous challenges that that region faces, and also the cascading effect of the marginal only revival in OECD markets playing on emerging markets to a positive extent. So overall, the stance is a hugely positive one. While no rate cuts have come, clearly from the 29th of January, you can begin to see the RBI reversing its stance on interest rates.
Okay, that's the latest that we are getting in. Thanks very much, George, for putting perspective. So an absolute non-event this time around, unexpected lines. And as George mentioned, the only positive that we can garner is that now the policy stance is going to remain rather dovish and that the focus is going to remain on growth. Indranil, what is your sense of this time's move? The rupee reacting very strongly. It's 54.84, but the market's rather subdued.
I think the stance has been set up for quite some time, that they are sort of tilting towards growth, no doubt. But as I was pointing out in the pre-monetary policy review, the big risks for the RBI is the CPI inflation. And let's remember that CPI is, the food component of the CPI is almost 49%, and most of the food items continue to be on the higher side. So there's a big risk for the RBI to signal a rate cut, and somebody on the show also indicated that it is unlikely to do much good to the investment demand cycle anyways. So I think the RBI is still preferring to remain cautious on the inflation front rather than really swinging its stance towards the growth front. And I believe going forward, the various factors that need to be built into the picture is whether we see a sensible fiscal correction, whether we see a sensible correction in terms of the CAD, both of which are looking not too likely at this point in time, whether we actually see inflation on the CPI side coming down because the WPI has come down, whether therefore CPI follows the WPI. I think all these incremental sort of data points need to be factored in before the RBI therefore goes in for an actual rate cut.
Right, Bharat, if I could bring it to you, your take on the RBI's stance of not having done on the rates front, because there was some expectation in the equity markets that you might see a cut on the repo?
You know, like I've been saying for a long time, this is not the what is really critical at this point in time. And my own view is whether they decrease rates or not would not have made any difference to the structural problems that we're facing today. The real, I mean, if you ask me to name the two biggest issues that we have today, it's clearly inflation and fiscal deficit, both of which are having a far greater impact on the slowing GDP growth rates than anything else. And the RBI governor has made it very, very clear in the past, and you know, I don't know how many more times he needs to say this, that unless he sees, you know, policy action towards correcting these two issues, it's going to be very, very difficult for him to actually cut rates. And one thing that he's not saying, but which I think is implicit in most of the statements that he's making, is that the last thing he wants to be held responsible for is a situation in the economy which sort of gives rise to the big S word, which is stagflation, which nobody is talking about. But there's a very clear danger that if you keep cutting rates and keep injecting greater liquidity into a system where you know, structural inflation has not been brought under control, there is another danger which could actually cause a far greater damage to the Aam Aadmi than anything else. So I think he's, you know, you can realistically expect some kind of a rate cut in January or February if there is sort of policy action taken towards you know, controlling fiscal deficit, and if the inflation numbers continue to sort of come under control. You know, people mentioned the fact that, you know, the numbers look much better this time around than they did last month. Of course they did, but you know, one swallow does not a summer make. And secondly, more importantly, while the inflation number has come down, it's not come down anywhere near the levels that the RBI in the past has said is in its comfort zone. I mean, you know, we used to live not too long back in an era where inflation was 3.5%, 4%, and now we seem to be happy saying, look, it's just a tad over 7%, let's cut rates. And I think that's dangerous. So, you know, I'm completely in agreement with, as usual, with what the RBI governor has done.
Sure. So, you know, Vaidyanathan, just bringing it to you and picking up on the point that Bharat made, would you also be of the view that the solutions to pretty much all the problems that the Indian economy faces lies closer to North Block than it does to Main Street?
Well, the short answer to the question is yes. I mean, a lot depends there. But, you know, I would not be as hawkish as the previous speaker with regard to the emerging situation. I do feel that, you know, when you go back in time and see what happened for the last maybe couple of years, the RBI governor repeatedly told the government saying that you need to move for me to be able to do something about this whole interest rate thing. And the fact that they have moved thus far in a parliamentary democracy that we are is something that is really very significant. You know, moving the FDI and retail, moving the land acquisition bill, and so on and so forth. These are all not something to be ignored. I do feel that the RBI will take this into account, and therefore I do feel that they will broadly stick to their guidance of the January to March. I would not worry very much about what the inflation numbers are going to look from here, because broadly they look to be under control. If nothing, at least they're looking like stabilizing, and growth looks to be a bigger issue, and I think RBI will be very cognizant of that.
Right, you know, Indranil, just bringing it to you and staying with the topic of inflation. Now, the RBI has put out its guidance and, you know, indicated a number of 7.5% for March 2013. That's where it sees WPI inflation at. The government, the finance ministry yesterday gave out an indicative 6.8 to 7% number for inflation in March 2013. Would you say that the government number is somewhere just being rather optimistic, and that 6.8 is a number that we aren't going to get to?
I think without even looking at what the actual number would be, in my sense, the 6.8 versus the 7.5 is no different. Anyways, it is looking at a softening of the inflation from the current levels. But I think what is more important from the RBI's point of view is the quality of the inflation and what are the factors that are leading to an inflation decline. Now, most of us analysts know that most of the inflation decline is possibly going to come out of a base effect issue. And unless the economy actually corrects for the aggregate demand side, which is basically bringing down the CAD as well as containing for the fiscal, it is not really a huge qualitative difference in the type of the inflation that we are looking at. and in type of sort of reducing the inflation expectations for the economy. So I think these factors are also becoming extremely important for the Reserve Bank of India. Looking at a 7% or a 7.5% number may not be extremely helpful at this point in time.
Mr. Munza, coming to you, the RBI has spoken about non-food credit actually having shown signs of picking up over the last few weeks, while at the same time deposit growth continues to remain sluggish. Are you worried about the structural challenge that this widening wedge between deposit growth and credit growth is going to create for the banking system?
As far as the credit growth is concerned, if we look at the pattern of credit growth, it is not significantly different from what it was during the same period of the previous year. We have the latest data available, where as on 30th November, the Y-to-Y credit growth is 17.05 and YTD is 7.53 as against 17.77 and 7.48 in the corresponding period of previous year. So that is where the credit growth is. Of course, on the deposit growth, there is a significant difference is there, and it is around 5%, because Y-to-Y deposit growth is something like 12.76, whereas the last year for the corresponding period it was 17.93. But interestingly, if I look at YTD, then the deposit growth is 9.13 in the current year, and it was 9.71 in the same corresponding period of the previous year. So it's not much of a difference. The point which comes out that probably the first half of the deposit growth in the year was sluggish, and this indicates that it is now picking up. So while there is a gap, and there is certainly one need to prepare a strategy for that, but it also indicates that of late the deposit growth has started keeping pace. And moreover, I think there is some liquidity which is held up in the system on account of the spending release or some of the payment. So if one can expect that once this money comes into circulation, it releases, probably this gap will be narrowed. But having said that, yes, if I look at the pattern of the previous year, this year till now is a challenge, and banks would be required to manage it, have to remain quite conscious about it all the time.
Sure, but Mr. Munza, to the extent that you had the latest consumer price inflation number at nearly 10% at 9.9, and the expectation that it's not going to come off anytime soon, do you expect that this one big factor alone is going to reduce savings of most households and ensure that deposit growth continues to remain sluggish for some time at least? Would you say that that's the one big factor?
Mentioned very rightly, but if we look at the components that, if we try to visualize that what must be causing this kind of CPI, then if I look at it, probably one is, of course, the crude oil prices. The second will be the real wages in the economy. Third would be, I would say, the MSP, which is going into the agriculture economy or the rural area. And probably the fourth would be the so-called protein inflation. So it will largely depend on how a bank's reach is. And to my sense is that the availability of the deposit, availability of the liquidity from your segment, which is in the rural area of the country or semi-urban, would continue to be strong. The current CPI and this behavior may have some impact on your deposit acceleration or deposit mobilization in the urban areas. And that is why I have been maintaining it that deposit growth as a one factor, now it cannot be looked like that, because the pattern of saving has significantly, it has become different in the various parts of the country. So what you are mentioning may be largely true in case of the urban and metro areas, but the deposit mobilization from the other branches, rural and semi-urban branches, would continue to be strong, and that is why largely it depends on how a bank is spread out. The ability of bank would be largely determined by that.
Right. Indranil, just coming back to you and staying with the topic of consumer price inflation. Now, while it continues to rule at near 10% levels, you continue to see both, urban and rural wage hikes in the region of 16 to 7, or rather 17 to 18%. For some time it's been there, and it's expected to remain at those levels going forward. Do you believe that as long as wage price pressures remain at those levels, we shouldn't expect inflation to come off meaningfully, or do you believe there is a fix?
No, exactly. That's the point that I've been trying to mention. So basically, again, you're coming back to the same story of containment of the aggregate demand. And the first indications of containment of the aggregate demand is in a falling fiscal, is in a correction of the CAD. And therefore, I think we are linking these wage price spirals to the demand in the economy. And hence, we have to sort of contain even the wage upward wage pressures if we are to sensibly bring down the aggregate demand in the economy. So I think you are right in saying that the challenge for the RBI is therefore even more because it is sort of fighting against the wage pressures and therefore the price pressures, and seeing very little opportunity of capping the wage pressures is actually building in the whole haziness in terms of how the RBI needs to react in terms of its monetary policy.
Bharat, wanted to come to you and just to talk about, how you expect the kind of future action and what that implication will have on the markets, because the Reserve Bank of India has been saying from the start that they are going to go ahead and cut rates in the fourth quarter. What do you believe the impact will be on the equity markets? Do you think that's perhaps already been factored in?
I think the impact is going to be exactly the same as today's RBI policy, which is no change. I've been maintaining for the last couple of months now that the market is on a bullish trajectory, but for reasons that have little to do with fundamentals. I think the global liquidity situation is extremely benign, and that's what you need to sort of keep a watch on: global bond yields and global liquidity, because that's where really the money is coming from, which is sort of fueling the upward momentum in equity markets in India. And as long as that situation remains the way it is, I think the markets will continue to move up. But remember, this is purely for technical reasons and not fundamental. And I do believe that maybe it will be difficult in December, considering that we're pretty close to the end of December, and most people will be off on vacations pretty soon. But my own belief is that in the first quarter of the next calendar year, you will see markets trying to make new highs in India purely on the back of the liquidity factor that I talked about, which has nothing to do with fundamentals, as I keep repeating. And if sort of Indian fundamentals improve, then I think you could be in for a structural bull market next year. But if that does not happen, i.e., the oft-repeated factors of fiscal deficit, reform, etc. If those are, if expectations are not backed up by actual implementation, then I think you could see a correction going into the second quarter of the next calendar year. But I think the immediate trend is up, regardless of what has happened today.
K.R. Bharat, thanks very much for joining us on the show with your perspective on the challenges before policymakers in terms of getting the economy back on track. Mr. Munza, I'm going to bring it back to you. And, everyone has been saying for some time now that the slowdown has bottomed out, that from here on things are already beginning to look up. In your experience, when you engage with a number of your customers, your clients, what's the sense you get? Are most of them, is that sense of optimism or relief of some sorts coming back to them? Are a number of them, again, beginning to engage in conversations with you about, getting projects once again started? Is credit offtake beginning to show signs of picking up once again?
I'll again, I think, bring you, as far as if we look at your question number one in terms of figures. As I said, as far as if we go by the growth figure, the credit growth this year is nowhere significantly different from the credit growth in the previous year during the same period, whether it is Y on Y or whether it is Y to D. So that is the fact. Maybe the components of growth or segments growth may differ, but overall figure remains the same. That is the one point. Second, as I mentioned, number one, a number of measures has been taken by the government, which has certainly created a positive sentiment. And when the clients interact with us, at least sentimentally, they echo a much more confident tone than what it was yesterday. The third thing which I mentioned when I was discussing on the previous point, that if I pick up the few components, like export credit, new orders growth after September is continuously rising. PMI, IIP numbers have come better, whatever it is. Then if I look at the investment, that is the capacity formation, it is 4.1 for Q2, whereas it was 0.7 for the Q1. Even the equity market and the primary equity market, the positive sentiment is getting reflected. I think these things all put together, there is certainly a much more confident and optimistic atmosphere in the client segment, that I much can say. Of course, segment to segment, some difference will come. Maybe there are few segments in the economy where there are still, there are concerns, or for that matter, if I take the real estate sector, the commercial real estate, that too in certain pockets of the country, I think they have a cautious tone, but it may not necessarily always be related to a rate of interest issues. There may be other policies issues around it. So my sense overall, if I put all these things together, that yes, there is more optimism. Of course, this will not result into that suddenly there is a capacity creation or the announcement of new projects overnight. But I think the preparedness looks certainly better than what it was yesterday.
All right, Mr. Mundra, thanks very much for joining us on the show today with your view on how banks are experiencing things beginning to change on the ground. Now, Vaidyanathan, just bringing it to you and picking up on the point that Mr. Mundra made about confidence having come back within industry. You'll agree that confidence by itself doesn't mean anything if it doesn't translate into action on the ground. Now, looking at the growth numbers, 5.5% growth in Q1, 5.3% in Q2. Policymakers insist that Q3 is going to look much better than Q2, possibly even better than Q1. And you have the government talking about growth for the entire financial year at 5.7 to 5.9%. The RBI's own take is that it will come in at 5.8%. Your view, do you believe that in the third quarter, when the RBI puts out the monetary policy review, it might actually revise the growth outlook possibly downwards?
Oftentimes these growth projections have gone wrong, even from the government for that matter. So just leave aside those projections for a moment. I would look at a little more fundamentals. If you look at the immediate past few numbers, car sales are down 8%, two-wheeler sales are tepid at about 5%, commercial vehicle sales are down. If you look at the immediate numbers, don't look that good. But if you fast forward this just 3 to 6 months from now, I am a huge believer of what the CRR can do. And the 1.75% reduction that the RBI has done over the last, maybe since the beginning of this year, according to me, will dovetail into a significant factor in terms of what it would do to availability of liquidity and in fact growth as well. In fact, I would say that the government should actually thank the RBI for what they've done on the CRR front and not bother so much on the repo rate front. So really, I do look forward that things are going to improve over the next 2 quarters without getting drawn into whether it's 5.9 or 6. I think basically because of what has happened in the CRR front, coupled with what the government is showing resolve to do parliamentary approvals, I think next 2 quarters are definitely going to look better. And maybe when we wake up 4 quarters from now, we'll find it different.
Right. Vaidyanathan, we'll come back to you in just a moment. We've got Dr. C. Rangarajan, the Chairman of the Prime Minister's Economic Advisory Council, joining us on the show. Dr. Rangarajan, first up, the RBI's stance, the policy stance turning hugely dovish, talking about the fact that the monetary policy will now shift focus and look to support growth going forward. Would you view this as a huge, a real positive sign coming from the central bank?
No, I can't hear you well, but if you're asking my reaction, I will only say that the Reserve Bank has taken a cautious stand. Some people might say too cautious a stand, but the numbers as indicated by the CPI and WPI have been contradictory, but there is a clear indication that the Reserve Bank would in January, follow a policy of monetary easing. A clear signal has been given even in the current statement. No,
right, Dr. Rangarajan, we'll
properly.
just come back to you in a moment. Yeah, we'll fix that line for you. But in the meanwhile, Indranil, I'm going to bring it back to you. You know, this point about inflation that some economists made over the last couple of days, really after the November WPI inflation came out, that inflation headline number has come down for 2 consecutive months. So there is a case for the Reserve Bank of India to cut rates today. It hasn't, of course, but ideally, would you have liked to see a rate cut?
Definitely no, because I think what Dr. Rangarajan has been saying is extremely correct, and I have been also airing this view. The wedge between the CPI and the WPI has increased very significantly, and in an economy where food inflation is on the higher side, and food inflation and fuel inflation is a much bigger chunk even within the Asian basket. It is too early to sort of say that we have won the battle over inflation, given the fact that food inflation continues to be on the higher side, and therefore the CPI is on the higher side. Now, as I had been mentioning, I think the clear indications for the RBI in terms of its achievements against inflation would also be a hand-in-hand policy from the government's point of view in terms of fiscal pressures on the economy coming off, and in terms of the CAD actually correcting. And I am not really seeing immediate big good signs on both these variables. So I think the twin deficit problem would continue, and that is possibly likely to keep inflation on an elevated path, while growth can be on the slightly weaker path. But it actually creates problem for the RBI in terms of moving ahead with a rate cut.
Right. Also, Indranil, the fact that the RBI has flagged off the widening current account deficit as a concern, and the concern over the direction that the rupee could likely take, would you view that as a big speed breaker for us? Indranil, if you can hear me all right, the RBI in its mid-quarter review has spoken about the, the wide current account deficit, the concern over the direction that the rupee could take, and, basically concerns on the current account deficit front. Would you view that as a big hurdle going forward for the, for the India growth story?
No, I think yes, in the sense that, see, the problem for the current account deficit is also the fact that the oil imports are not likely to come down very significantly. And I think what is really happening is that with the global liquidity pressures, even though some amount of demand containment can happen for the oil, from the oil perspective, it actually sets a floor in terms of the oil prices in dollar terms. Plus, given the fact that the global situation in terms of the overall macroeconomic atmosphere is relatively weak, and there could be further risk of momentums driven by the European problems. Even though US might be able to see through the fiscal cliff issues, there could be pressures on the domestic currency as well. So overall implication of this on the subsidy bill for India is negative. Overall implication of this on the CAD is continuing to be negative, given the fact that both the export side of goods as well as services is unlikely to pick up very significantly. So I think this is something that we really need to, in terms of a policy making perspective, really need to take cognizance of before we actually sort of talk very clearly about a growth revival or an inflation containment.